Good afternoon, ladies and gentlemen. Welcome to today's webinar, Family Investment Companies Tax and Estate Planning, which I'm delighted to say that we're doing in association with MHA. My name's John Gaskell. Before I introduce our speaker, I'd just like to run through the logistics of how today's session will work. So, as I'm sure you know, we have an hour for the session, and we very much aim to make it as interactive as feasible within the time slot that we have. So we're going to have around 10 to 15 minutes at the end to deal with some of the questions that come in. So I'd encourage you to submit your questions during the course of the presentation, which you can do very easily at the bottom there on the Q&A. Also, if you do have any technical problems, if you could please also just submit whatever they are, then we have somebody on hand here that would help you to deal with that. Very unusual that we do have technical problems, but you never know. And as I say, there is somebody there that can assist with that if that should arise. So we have a lot of material to cover today, and I'm delighted that we have James Kipping, who has got a wealth of expertise and experience in this really rather complicated area, but of an area that is of increasing importance and interest. So without further ado, I'd like to pass you straight across to James. James, over to you.
Thank you, John. Good afternoon, everyone. By way of intro, I'm a tax partner, head of private client at MHA, based mainly out of London. We do a fair bit of work in this area, now quite a lot in conjunction with our wealth management arm, MHA ICAEW Wealth. As John said, please do submit questions. I'll try and go through them at the end. Not 100% sure on timings, but I'm hoping for 10-15 minutes for questions. Anything we don't get through in terms of questions, I will hopefully be able to follow up afterwards. And of course, my details are on the slides, and you can contact me should you wish after the session. But let's crack on. So what are we going to cover? Well, I'm going to cover the basics of what is a family investment company, the key features, with some kind of practical pointers or tips, what a typical structure might look like, or actually several typical structures, some tax traps, so that's things like the settlements legislation, reservation of benefit for inheritance tax purposes. You will see that throughout the earlier sections I'll be occasionally mentioning trusts, so I'll have a little session in the middle on how trusts can be used in the share structure of a family investment company. And whilst I'm focusing mainly on someone who's coming to us with some cash to invest and to set up a structure from scratch, I'm very, very conscious that quite often there are existing investment companies, and we get many inquiries from people wanting to do some planning with existing established companies. So I'll cover 5 or 10 minutes on that as well, and then I will speculate as to what the future might hold for tax planning and family investment companies. Without further ado, then I'll just move straight on to, well, what is a family investment company? Well, as the slide says, it's a bespoke vehicle which can be used as an alternative to a family trust, essentially. I should also say that I may well use the term FIC rather than family investment company throughout. Hopefully that's okay. Fundamentally, though, FICs are just companies with shareholders and share capital, and directors responsible for the day-to-day operation of the company. They've become popular, or more and more popular, particularly since the changes to trust taxation in 2006, because they can replicate many of the features of a discretionary trust, but without the tax implications, principally the inheritance tax entry charge and 10-yearly charges associated with discretionary trusts. That's not to say that trusts in conjunction with family investment companies can't be very, very efficient. Like a trust, FIC typically enables parents to retain control while wealth is held for future generations. That's really what we're trying to achieve here. Clients often find trusts complex and want sort of kind of shy away from them occasionally, and I can understand that. Yet they tend to understand companies, typically because they've been in business with companies throughout their working life. So they're comfortable using a company, and that helps and makes discussions with clients much easier, and it helps them understand the types of planning and opportunities that we will discuss today. Over the next 4 or 5 slides, I'm going to run through what I see as the key features, split up into sort of compartments, if you like, and then I'll hopefully bring it to life a little bit with some examples once we've run through the key features. But in terms of setup and funding, the first one on the table there, corporate form. 99 times out of 100, we'll use a limited company, but there can be reasons why an unlimited company may be preferable. Principally because with an unlimited company, there's lighter filing requirements at Companies House, and sometimes that greater degree of privacy is important to clients. I have to say that with clients that have been in business, they tend to be not particularly concerned about the information that's filed at Companies House. In terms of funding, I said at the start that I'm going to focus on someone who comes to us and wants to invest efficiently with cash, but we do get questions regularly about funding a company with existing assets, principally property. Investment properties is a typical one. Now, it can be done, but what we need to consider more often than not is that a transfer of assets or property typically to a family investment company, or indeed any company, as a disposal for CGT purposes, and there can be SDLT charges. There are reliefs if there's a transfer of a business, but it tends to be much more difficult. So I'm going to focus on someone with cash to invest. So if you have got cash to invest, how do you use that to fund the company? Well, this is probably quite obvious and not particularly complex for the audience, but that cash can be used to invest in share capital. And in that respect, we might be considering different share classes and rights attaching to those shares to meet the family's requirements, or principally the parents' requirements in terms of control and the ability to be flexible with income and capital. Aside from share capital, a great deal of flexibility can be obtained by simply loaning money into the company. The only point I would make there is that we would always say, or 99 times out of 100, say that loan, that director's loan, if you like, should be repayable on demand. That's important so that there's no transfer of value for inheritance tax purposes by the parents. Okay. In terms of share capital, voting rights can be different across share classes, and it's not uncommon for parents to give away shares with no or limited voting rights such that they retain control of the company. That's fine, and there can be good reasons for this, but practically we just need to remember that voting rights can have a material value. So if parents have a minority of share of capital, but with the majority of the votes, their shares may be worth more than might be expected of a minority holding, even if that only prevents a valuation discount being appropriate. In terms of income, we find that alphabet shares provide sufficient flexibility. No doubt most of you are familiar with the concept of alphabet shares. Practically, it's often appropriate to consider defined pots for each class of share, and as we'll see later, and prudently, it's recommended to restrict dividends where the Gifford reservation rules for inheritance tax may be in point, and I'll cover that in a single slide later on in one of the sort of tax traps sections. Equal capital rights across shares is usually appropriate, but there are a couple of situations where that may not be so, and it's on the right hand side of the table here. One being in growth share planning for existing companies, which I'll cover in an example later on. Another is where the company is funded by preference shares, which may make it easier to return capital more easily and free of tax. And preference shares may be used where perhaps there's no director's loan, or in place of a director's loan. Okay, in terms of governance and control, fairly obviously, directors are responsible for the day-to-day running of the company. I find sometimes shareholder voting rights in this situation can be overstated as an issue by clients. For example, where they're proposing that children have a minority stake, there may be no reason to restrict voting rights. And often a shareholders agreement can cover off most of the potential issues and help to manage expectations within the family. I suppose what I'm getting to here is sometimes we can make things more complex than they need to be by fiddling around with rights attaching to shares, and sometimes simplicity actually works out better in many situations. Who can benefit from a family investment company? Again, most of this is probably quite obvious, but hopefully the practical points are what are useful here. Shareholders and employees can obviously benefit, but obviously, or often, clients want more flexibility than that, and that's where we might recommend introducing a flexible discretionary trust as a shareholder. And to that extent, as I'll cover in an example, clients can defer the decision as to who gets what and when. Capital, in terms of a distribution, is not so easy, which is why loan capital or preference shares are recommended when clients might want to or might think they need to access capital easily at some point in the future. We're often asked, and I touched on this in the intro slide, but we're often asked by clients whether they can use assets of the company, such as properties and what have you. So use them personally, or can we transfer in a holiday home, or can a holiday home be acquired through the company? Excuse me, I've got a bit of a dry throat. As you're probably aware, this type of thing will often have several adverse tax implications, and as a general rule, it's much easier to use the family investment company only for investment assets. For example, with property, the ATED charge will apply to properties available for use by the client or connected people, and where a relief doesn't apply. Keep it simple, again, is probably my message. Oh, sorry. In terms of the tax position, and this is kind of the nitty-gritty of the talk, I guess. What was I going to say? Yeah. So the tax position. So we're looking here at the tax position for the family investment company itself. Obviously, the rate of corporation tax at the moment is 19%. We expect that to increase to 25% from April 2023. But with what's going on, the Tory leadership situation, we're not 100% sure on that yet. As a practical point, I'll just note that the small companies rate from April 2023 will not apply to close investment holding companies, and many FICs will be close investment holding companies. In terms of tax on capital gains, again, within the corporate environment, we're taxed at 19%, the corporation tax rate, or 25% from April 2023. The practical point here is just watch out for assets that fall within the loan relationship regime, such as corporate investment bonds or life insurance policies held by a company. And in that situation, the company can be taxed on the growth in the year, even though they've not realised a gain, depending on the accounting treatment. I believe where a company can make use of FRS 105, that's not a problem because they don't have to apply fair value accounting. But I'm no accountant, so submit questions for me to ask a colleague if you're not sure. Interest expenses and management expenses. The message here, I suppose, is that individuals cannot obtain relief for interest on loans to acquire a portfolio of shares, for example, and they cannot obtain relief for expenses of managing a share portfolio. A company should be able to obtain relief normally for those types of expenses. Distributions of income. So this is when we're looking at distributing assets from a company or income or money from a company. Obviously, dividends are taxed at the appropriate rate or the marginal rate of the shareholder. That's between 8.75 and 39.35%. The advantage of a company, though, in this situation is that by using a company, we can control the amount of dividend income arising to the shareholders. So to manage income and manage an individual's income tax position. And one fundamental point I probably didn't raise in the previous slide is that, of course, whilst the main rate of corporation tax is 19%, dividends arising to a company typically aren't taxed at all. So we can achieve a tax deferral by having dividend income arising to an investment company and only distributing what is needed and when. Okay. Alphabet shares provide flexibility as well, and it's worth remembering that the shareholders should have a £2,000 dividend allowance personally as well. From an inheritance tax perspective, shareholders pay inheritance tax, rather their estate will pay inheritance tax on the value of their shares. And I'll set out an example much later on in the talk about how valuation discounts for minority holdings can be particularly useful in the context of a family investment company. One thing that doesn't appear on the slides here is that in terms of distributing income, or in terms of an efficient remuneration policy, the FIC can be used to make pension contributions for directors or employees, which of course typically will be family members. And that might not be possible if the investments were held personally, because of course with personal pension contributions they need to be franked by net relevant income. Sorry about my my repeated coughing. Right. Typical structures. Well, hopefully now by looking at some structures over the next few slides, some of what I've just run through will start to come to life. But just to run through this slide in terms of what a typical structure might look like, and therefore how the tax planning comes into play. It might be that parents provide funds to the family investment company in the form of either interest-free loans or subscribing for preference shares. In that respect, there's no transfer of value for inheritance tax purposes, but that loan or preference share capital means that funds can be extracted from the company easily at a later date tax-free. The parents might also subscribe for voting shares in the family investment company, which give them control of the company at shareholder and board level. The parents could also subscribe for a class, or indeed separate classes, of non-voting shares, which are then given away to the children, here usually adult children, before significant value accrues. It might actually be that they give cash to the children who then subscribe for the shares themselves, but that's, you know, semantics, I suppose, in the scheme of things here. Aside from direct gifts of shares to family members, the parents could also put funds of usually up to 662,000 into a discretionary trust for the benefit of perhaps their minor children without triggering an IHT charge. That 662,000 is 2 nil rate bands of 325,000 each. Here I'm thinking mum and dad, and if they've not used them, their annual IHT exemption of 3,000 each, and the brought forward allowance as well. Just in terms of the trust, if that's the case, the parents should be irrevocably excluded from benefiting, and the trustees will then subscribe for a class of non-voting shares, typically in the FIC at market value, i.e. nominal value if the company is being newly created. Okay. So this is the first of several slides on what a typical structure might look like. I should add that, you know, sometimes there isn't a typical structure. Really, the first thing I would often do is say to a client, what do you want to achieve? And then we'll try and make that work in the share capital and how the company is funded. And in these examples, I'm looking at a family investment company being created with, say, £2 million of cash. That's not to say you need at least 2 million to set up one of these. It's just for this purpose that number seems sensible, and it worked. Here I'm suggesting the clients, parents, that's mum and dad, actually want to retain a significant interest, so they hold 52% of the company to give them the control. In this case, the shares allocated to the children may not need to be non-voting shares, because the parents have control by virtue of their ordinary shares anyway, therefore making this structure incredibly simple. If the parents needed to retain less of a capital interest, we may restrict the voting rights allocated to the children's shares if they have a greater part of the share capital. And again, I'm assuming here that the children are adults. The company is funded entirely by loan capital. So I'm saying that nominal share capital of £100 in the proportions £52 mum and dad, 48, child 1 and 2, and the 2 million is loaned into the company from mum and dad to give them the flexibility to extract capital without tax or money without tax. But the clients must remember that in this case, the value of the loan remains in their estates for IHT purposes. The children's shares are of separate classes, and that allows different dividends to be paid from the company as profits arise. I suppose the other thing to mention here is with this loan and the fact that the parents might extract tax-free against this loan, it does mean that they are effectively as an income, they are using their capital as an income. So as time passes, a proportion of the growth in value of the company is accruing directly to the children and outside of their estates, and they're eating into their capital by paying and by repaying their loan effectively as an income for them. This next situation is a little more complex because the parents don't want to retain a shareholding. Essentially, they're saying, we don't really need probably much of this capital or the growth in value that hopefully arises from it, or the income that's arising from it. So estate planning is very much the focus. So in this case, I'm suggesting perhaps 650,000 of shares are held by a family trust. That's 2 nil rate bands. I've not considered the annual exemptions here, but we could, as I explained in a previous slide. Mum and dad are trustees, giving them control. I've said these are voting shares, but given that the number of shares would give them control anyway, we may not need to fiddle around with voting rights in this scenario. The children have a further 600,000 of share capital, 300,000 each, and that for inheritance tax purposes would be a gift by mum and dad, a pet that falls out of their estates after 7 years has passed. All value, or rather all growth in value here, accrues to the trust and the children, and therefore outside of the parents' estates for inheritance tax. And the initial value of the 1.2 million to 1.25 million share capital will be outside of their estates after 7 years. We have got to remember that the trust is subject to 10 yearly and exit inheritance tax charges, and I think I'm going to cover that in a later slide. The difference between the 2 million and 1.25 million share capital is provided by way of a loan. Again, to provide that flexibility and access to cash. The loan remains in their estates, but again, as in the previous example, repayments as an income over many years means that they're living off their capital, depleting their estate for inheritance tax purposes, yet retaining control of the company as trustees of the family trust. This final slide, simple one really, it's just a reminder that even if estate planning is not an objective, a company for investments can be extremely tax efficient and would usually be funded entirely by loan capital. It's a simple structure, and if the money is invested in a general investment account earning dividend income, for example, tax need not be paid for many years, yet cash can still be extracted effectively as an income by way of loan repayments. So, profit extraction. It's not always possible to retain profits, or even desire to retain profits in the company or pay them out as a loan repayment. So if you're in that position and all profits need to be extracted as dividends, this slide shows that in respect of non-dividend income, because of course dividend income will be taxed at 0% within the company, in respect of non-dividend income of the FIC, the effective tax rate is higher than if the individual makes investments personally. So if the client is just wanting to extract all income derived from the FIC and it's not dividend income, it's going to be less tax efficient on an annual basis. This of course ignores the IHT savings, but is sometimes why we say that a family investment company is not always appropriate. It's likely, or it's more likely to be appropriate where there is the estate planning and IHT planning opportunities alongside the sort of setup of the company. So there's rates on the screen. I'm not going to run through the rates on the screen in the interest of time, but the first slide here covers what the effective rate of tax would be on full extraction with current corporation tax rates. And the next slide updates that for the expected rise in corporation tax from April 2023. Okay. Tax traps. Yes, right. So that all sounds marvelous, but of course there are several things to be aware of from a tax perspective. Firstly, the settlements legislation. Now, this is an anti-avoidance provision that aims to prevent, say, high-earning taxpayers from making use of tax allowances or lower rate tax bands of, say, a lower earning spouse, partner, child, or indeed anyone else. And where the settlements legislation applies, the income remains assessable on the settlor, so the person who has made that settlement in favour of someone else. For the rules to apply, there needs to be an element of bounty, or in the cases of spouses and civil partners, there must be a gift of wholly or mainly the right to income. So dividends paid proportionally to shareholdings between spouses should not generally cause a problem. But if higher dividends are paid on a class of share held by the spouse, or if a dividend waiver is made to increase the dividend payable to the spouse, the settlements legislation can apply to tax the income on the higher earning spouse. That's hopefully you're probably familiar with much of this. There are also the parental settlement rules, which will apply this same legislation where income is diverted to minor children. So generally, income cannot be paid directly or through a trust to someone's minor children just to save income tax. But the rules will generally not apply where income is diverted by grandparents to, say, their grandchildren, or by parents to their adult children. So it's the opportunity for income tax savings using these structures is much more available where we are dealing with those who are not minor children. From an inheritance tax perspective, we have to consider what are known as a gift with reservation of benefit rules. Now, these apply where there's a gift. So in this case, for example, the gift of cash or share capital at the outset, where capital is put in, say, a family trust or into the names of the adult children or whoever. And that property, in this case the shares, is not enjoyed to the entire exclusion of the donor, so the individual making the gift. In my example, that would be the parents. In that case, the value of the gift remains in the estate of the donor for inheritance tax purposes. Effectively, the gift is ineffective for inheritance tax. Now, this is most commonly referenced in connection with gifts of the main home, for example. This is where you often hear about the reservation of benefit rules, where if the donor continues to reside in the property, they would need to pay a market rent to ensure the gift is effective for inheritance tax planning. Applying this principle to family investment companies, it's possible, although the position actually I don't think is clear, that there may be a gift with reservation where an individual, say, gives a large proportion of the share capital to children, but retains shares with dividend rights and perhaps pays disproportionately high dividends to themselves on those retained shares. So what we would usually do to guard against this is recommend a restriction to the dividend rights in the articles, and perhaps just consider each class of share having a fixed entitlement to profits, potentially proportionally across the shareholdings as income arises, or certainly ensuring that the shares retained by the parents cannot benefit from a disproportionately high dividend return. What time? We're at past, perfect. Use of trusts. So I've mentioned using trusts as a shareholder for asset protection. This can sometimes be a difficult well, I say asset protection, it's not just asset protection, it's control, flexibility, and the estate planning opportunities that hopefully were clear from my earlier slides. This can be a difficult conversation to have with clients because sometimes they don't like trusts, or they want to go into a family investment company to avoid using a trust. But nevertheless, they are very useful in the shareholding structure. My reference to trusts throughout this talk refers specifically to discretionary trusts, which ensure that the beneficiaries do not have any automatic right to receive the income and capital held in the trust. And in fact, they don't even need, well, the trusts don't even need to name beneficiaries specifically. They may instead name a class of beneficiary, and the trustees may retain the right to add further beneficiaries. So this, one way to kind of, if you like, sell this sometimes to clients is where they're setting up a company for family, and they might be grandparents, and they don't actually know whether or when further grandchildren might come along, but they want to ensure anyone benefits equally. Well, by naming grandchildren as a class of beneficiary within a discretionary trust, that is possible in this scenario. For completeness, on this slide, the first bullet point, I've mentioned that bare trusts can often be used to hold shares for other people, particularly minor children. Now, these are transparent from a tax perspective, so they're treated as if the beneficiary owns the shares, and the beneficiary has a right to income and capital and may call for both to be remitted into their own name once they're age 18. They're the beneficiary's asset and income for tax purposes, but as I've said, they may be used for holding typically minor children's shares in a family investment company. Probably the best thing to do is to use an example as to how trusts can be tax efficient. Hopefully from an inheritance tax perspective, you've taken away the point that obviously by settling up to the value of the nil rate band onto discretionary trust, we're starting that 7-year clock for the parents, and therefore that's the estate planning angle, albeit we have to remember that the trusts themselves are subject to inheritance tax charges on 10-year anniversaries and when capital is appointed out. However, in the first 10 years of a trust, provided there's been no IHT on the initial settlement, there should normally be no IHT on an appointment of capital in the first 10 years. What this slide here tries to show is how discretionary trusts can have income tax advantages as well as those estate planning advantages. So we have a family trust, which is a shareholder of a family investment company. There might well be grandchildren as a class of beneficiaries, and the trustees might want to use dividend income from the family investment company to pay expenses or pay an income to grandchildren beneficiaries. In that case, the trustees might appoint what's known as a defeasible or revocable interest in possession. That's a right to the income that can be revoked at any time by the trustees. And if there are, as in this example, 2 grandchildren, we might say pay a dividend of, being precise here, but £29,140, and that would then become dividend income of the interest in possession beneficiaries in equal shares, or the life tenants in equal shares. So each grandchild would have dividend income of 14,570, which of course, if they had no other income, would use up their personal allowance and their dividend allowance, so no tax is payable on that 29,140. If that dividend income arose to the parents, it might well be, or the grandparents in my example, that might well be taxed at the higher rates, and they'd be using income net of 39.35% tax to pay the expenses of the grandchildren. So you can see how over a number of years this can become very, very efficient, alongside the estate planning opportunity. What about existing companies? So, my focus has been on how to structure a new company, but often we receive inquiries from existing and established investment companies. Planning is difficult because a transfer of shares will typically be liable to capital gains tax. An increasingly common planning tool is the growth share plan, and the principles are set out on the slide here, such that the current value of the business is frozen into the existing shares, and a new growth share capital, sorry, the wording on the slide is not quite right, are issued to capture any future growth in value of the company. And I'll come on to how that's done in a second. Now, the growth shares in their infancy can then be passed into the ownership of other family members or trusts to remove that future value of these shares from existing shareholders' estates for inheritance tax purposes. The theory is that the new growth shares are worth little when they are issued, so they can be given away with few tax implications. Then, of course, the growth accrues outside of the estate of the donor. However, care does need to be taken in valuation. And my understanding is that HMRC are taking a closer look at growth share valuations. So certainly it is something that needs to be taken into account carefully. Now, this example, which actually goes over a few slides, is loosely based on a real life case I dealt with recently. Quite significant property investment company, 4 adult shareholders, 2 married couples. The whole company value was 11 million. Now, in creating the growth shares, we put a hurdle of 12 million in the articles. That goes to mean that the growth shares don't become of any value until the company becomes worth, or net asset value of the company is 12 million. In that case, the growth shares, although they weren't entitled to anything at the outset, they were still said to be worth, for CGT purposes, £1 million, on the basis that the valuation expert said, well, there must be some value to these growth shares. The value must be the future sort of potential return to the growth shareholders. And I won't go into detail as to how they calculated that, but the point from a tax perspective was giving away those growth shares worth £1 million. It might still be worthwhile, but there'd be a CGT charge at 20%, and it would be a 7-year gift for inheritance tax. So in that case, we said, well, what about a gift onto a discretionary trust rather than outright gift? Because of course you can hold over the capital gain where assets are transferred onto a discretionary trust. Now, you might think that based on the 1 million value, the value transferred by each of the 4 shareholders was 250,000. But remember that for inheritance tax purposes, the transfer of value is calculated based on the loss to donor principle. So the valuation concepts can be quite complex in this situation. But what does the loss to donor principle mean? It means that we compare the full value of the company today with the value of the retained ordinary shares. So those shares, the retained shares that perhaps parents will retain, are compared with the full value of the company. Now, the value of the retained ordinary shares is, I'm told, the expected return up to the value of the hurdle, which depends upon the rate of return required, etc., the level of risk and length of time before a sale of return or capital. The long and short of it, I'm not a valuation expert, but the long and short of it is the transfer of value in this situation was deemed to be about 600k, about 150k each. So the transfer of value for inheritance tax purposes was 150k each, and therefore no inheritance tax when the shares were transferred onto the trust, and capital gains tax holdover relief can be claimed on the way into the trust. And from a sort of further point, so I'll put a further couple of points on the slides here, that no inheritance tax return was required due to the value of the transfer being less than 80% of the nil rate band. Voting rights in that situation weren't restricted because the number of shares meant that the ordinary shares still retained control. And to guard against the possible application of the gift with reservation rules, we restricted future dividends for the ordinary shareholders to the value of the hurdle. In other words, we're saying the maximum that the ordinary shareholders can get out of this company, whether by capital or dividend income, is the value of the hurdle, 12 million. In that case, we suggest there's no gift with reservation. moving on to a slightly different situation, but a relatively common situation, is where a client in business is looking to sell their trading company, and following the sale, the shareholders' exposure to inheritance tax is going to be greatly increased because they will lose the protection of business property relief. So, taking a step back, shares in a trading company or a holding company of a trading group will typically qualify for business property relief, effectively exempt from inheritance tax. The minute those shares are sold, or rather the minute there's a binding contract for sale, the value of those shares falls out of business property relief and is exposed to inheritance tax. Often the planning in this situation, and quite rightly in most cases, is to go through the sale, pay capital gains tax with the benefit of business asset disposal relief, and then look to perhaps invest cash efficiently. And often a family investment company is sensible for at least part of the cash proceeds. From a tax perspective, that means that capital gains tax is suffered, perhaps not such a bad thing at the current rates, and the gift of shares in the family investment company remains in the estate for 7 years after it's established. It may, however, be possible to improve that where a client doesn't necessarily need to access the capital, just doesn't need the capital arising from the disposal of the family business. Now, in this slide here, just to set the scene, I suppose, we've got a fairly common group structure. Dormant holding company that might hold some modest investments, perhaps, but that doesn't trade. That doesn't taint the trading status of the group. The group, provided it's been in place for at least 1 year, if the trading company is sold by the holding company, will qualify for the substantial shareholdings exemption. So moving on to the next slide, what the Mr. and Mrs. X in this situation might do if they want to do inheritance tax planning, their shares currently qualify for BPR and they don't need the capital following the sale of their business, they might instead of extracting all the sale proceeds, they might sell the trading company from Holdco. Holdco will benefit from the substantial shareholdings exemption such that no corporation tax is paid by Holdco. In advance of that, Mr. and Mrs. X, whilst the shares still qualify for business property relief because it's the holding company of a trading group, they might transfer those shares onto a discretionary trust for the family. Now, irrespective of the value, because the shares qualify for business property relief, there's no inheritance tax on that settlement. The discretionary trust, rather the holding company then goes and sells the trading company, and what you have is a family investment, or effectively a family investment company of the proceeds of the sale in Holdco with no tax paid, all held under a discretionary trust outside of the estates of Mr. and Mrs. X. Now, even though the trading status of the group or the company has changed from trading into investment, because the original gift onto the trust was a gift of unquoted shares, provided the trust retains those shares for at least 7 years, if Mr. and Mrs. X or Mr. or Mrs. X die within that 7-year period, the BPR is not withdrawn. So effectively, they are divesting themselves of divesting their estates of the value of the trading company for inheritance tax purposes immediately. There's no 7-year rule provided the trustees retain the shares. And of course, Mr. and Mrs. X in this situation could be trustees of the family trust and retain control over the investment vehicle. Okay. Conscious that we've hit 1:45, probably 5 minutes more, and then we'll go to questions. In terms of making changes, I mean, clients will often set up a structure, be very, very efficient, and then they'll turn up in a few years' time and say, "Oh, I want to change something here," And I've just listed sort of typical things that come up. Can we issue new shares, or can we issue new shares to another family member? Obviously, market value principles apply, so that's very difficult. But we might have we might be able to provide further funding by way of new loans. That's possible, efficient, flexible. They might want to gift shares, and in that situation, we'd consider a family trust so that we don't crystallize CGT charges, or rather we can hold over the capital gains that would arise on a direct gift. Often they might want to think about changing share rights, and our message there is just be careful, because changing share rights, so income rights, capital rights, can create a transfer of value. A really common one is it might even be the next generation have an investment company, and there are sort of different sides of the family, and they want to break the company up, and often it's possible to undertake a partition demerger in that situation to avoid the need to effectively wind up the company. And actually, at some point in the future, clients may want to wind up the company, and at the outset, it's just important to advise of the implications of doing so. It would be a disposal of assets or investments by the company, and then typically capital gains tax on liquidation distributions. I won't go into the potential anti-avoidance and stuff around liquidations and CGT. That's for another day. I think we're on final 2 or 3 slides here. Just wanting to look at what might happen or could happen in the future. And I should start by saying, I suppose, that what follows on the next couple of slides is pure speculation on my part. It's not a case that these changes are coming in. I'm just thinking logically about what changes could be made to mitigate some of the advantages that can be obtained by investing in a corporate structure in the manner that we've discussed this afternoon. Firstly, in respect of retaining profits efficiently within the corporate vehicle, obviously very, very efficient where there's, for example, dividend income that can arise to a company tax-free and be reinvested, and tax will only arise when clients want to extract that income from the company. The Office for Tax Simplification report on capital gains tax in 2020 suggests potentially taxing retained profits within the company on a winding up or a sale of a smaller owner-managed company at dividend rates rather than capital gains tax, or even taxing them in the company at enhanced corporation tax rates. So if something like this were to happen, and it would actually be very similar to the old closed company apportionment legislation potentially. So there's some precedent here that could be used if we wanted to go down this route. That would obviously remove the sort of or restrict or reduce the tax deferral benefits that a corporate structure can present. Secondly, in relation to the valuation, and this is the final section, the value of the family investment company shares in the individual's estates or the shareholders' estates for inheritance tax purposes. And something I've not really explained yet, but which can be or can provide a significant inheritance tax advantage, is the ability to apply a discount to the value of minority holdings. Now, currently we have what's called the related property rules for inheritance tax, but they only apply to spouses. And what they mean is that when determining a valuation discount, or when valuing assets held by spouses, we must consider the aggregate shareholding of those spouses. But other shareholders' holdings are valued or considered independently. A fairly easy change to make to the rules might be to bring other family members, children, whatever, siblings, into the related property rules. Now, to kind of show what the current advantages can be, I've put this slide together. So again, we've got a family investment company, £2 million. Mum and dad retain 15% of the share capital. Adult children 35% each. In this situation, obviously a proportionate share of the 2 million net asset value is shown in the table there. 300k for each for mum and dad, 700k for each of the children. Now, if you had to value any one of these shareholdings for inheritance tax purposes, I would suggest, even with the related property rules, which mean we'd look at mum and dad's holding as a 30% holding, I'd suggest a discount of at least 20% would be appropriate. Based on HMRC's old guidance, we could potentially get away with more, but that kind of depends upon the facts of the case and the circumstances. But applying a 20% discount, Dad's 300k of shares proportionally might be discounted by 60k to 240k for inheritance tax purposes. Now, at 40%, that's an inheritance tax saving of £24,000 immediately upon the formation of this structure. It would be it can be a significant advantage, and it would be a shame if that were ever removed. And on that note, I think as the conclusion, family investment companies are increasingly popular. There are some complexities, but hopefully you've got from my talk that keeping them simple is often best advice. The changing corporation tax rate that we expect from next year makes them slightly less efficient. And there's the possibility potentially for future changes, but notably those potential future changes don't affect the estate planning benefits, which look at the moment to remain for the foreseeable future. And hopefully that was useful for everyone. I'm happy to take questions for the next 5-10 minutes or so. And I should say that because I'm sharing my screen, I'm not sure why, but I can't see the questions as they might have popped up throughout. So John very kindly, hopefully, will be able to read out some of your questions, if indeed there are any.
Thank you, James. Thank you for that. And there are lots of questions, and I'm delighted to say that we'll be able to pick up some of those questions afterwards. But for data protection rules, as much as anything, we've got a slide up there which kind of helps to address that. So whilst you're attending to that, I was just going to go into some of the questions, and there are lots, some more specific and detailed than others. So what I want to try to do is to try and batch some of these. But the first one that kind of has come to mind is there's a lot of complexity here, lots of planning opportunities, but clearly that comes with a cost of some form or another. So, yeah. James, have you got any idea as to the sort of value of money stroke assets that would be needed to make this proposition of a FIC worthwhile or viable?
It's a common question, difficult one to answer kind of definitively. I suppose I would say in the most simple form, then, cash, in the hundreds of thousands can make a FIC tax efficient. You've got to bear in mind the establishment costs and the ongoing running costs, but they don't need to be particularly significant. I think when you're getting into more complex share structures and you're involving trusts, then probably as a rule of thumb, we might say, look, it will work best, and you'll see the best advantages with a couple of million. But that's not to say we shouldn't consider this for people without that level of available resource.
Okay, thanks. And I think the point that you made earlier on as well was invaluable, which is the starting point, is that there's got to be a clear articulation and agreement on what the objectives behind the exercise are. And I can imagine in many cases that can be quite torturous, actually, arriving at that point.
Yeah, it can be. I mean, several things I would mention there. In raising this or talking about this as an idea with clients, I actually find it, on the whole, one of the easier things to talk about, because clients, our core client base is sort of owner managed businesses and they're shareholders, and therefore they tend to understand companies, how they operate, how they run, share capital, and that type of thing. So they can understand the concepts. Whereas it can be more difficult when talking about how we might introduce a trust and what a trust is and how a trust works and all the tax implications that go along with that. In terms of how this might, or the sort of expectations within a family, clearly you might have a situation where there's a trust holding shares for the next generation, or we might have, shares with, shares held directly by children, adult children, whether they're voting rights or not. And, often these work best where the families sort of sit around a table and the parents talk about it. We're doing this for the following reasons, and everyone therefore understands. And over time, parents who are probably doing this as they go into retirement, for example, might involve adult children in the operation of the company or the trust as directors or trustees. And that's a way of sort of managing that succession and understanding how what wealth there is and how it's managed can actually help when it comes to the inevitable that will happen eventually, in terms of passing assets on in the event of a death. And as I said, I think we'd always advise that clients should consider having a shareholders agreement to document how key decisions or key matters of operating the company are governed.
Thanks, James. So it's clarity, isn't it? Once you've established what the clarity, prioritization, documentation, sort of basic principles, really. So we've had quite a few questions around this whole concept of transferring existing assets, wealth, incorporating into a FIG. So just one or two of those. Can we transfer a portfolio of residential properties to an LLP and then later to a company? And then the second part is, will this avoid CGT or stamp duty?
It certainly can do. It could be the subject of another hour. But at a high level, if there's a property investment partnership operated as an LLP, typically family members can go into an LLP and transfer property into an LLP without CGT or stamp duty land tax, with some careful planning. Then at some point in the future, if the partnership business is transferred into a family company of the same shareholders, and I'm being careful to emphasize that this is a family. It can be more complex where there's non-family members involved, but nevertheless, the transfer of a business of an LLP, even an investment business, can qualify for incorporation relief if the incorporation is done correctly, so that no CGT arises, or rather the capital gain is deferred into the new shares of the company. And in respect of property, that transfer, rather like the same transfer into the LLP, the transfer out of the LLP into the company, would usually be governed by the partnership provisions for SDLT, which would usually mean no stamp duty land tax. Now, I emphasize usually because there are some complexities, and there needs to be real commercial substance to the sort of partnership itself. There are anti-avoidance provisions that can potentially be invoked where the partnership is simply used as a stepping stone into the company. The other point actually is to mention here, and sorry if I'm providing quite a long answer to this question, but this is something that's often talked about, and there's been I can't remember the name of it, I only saw it very briefly the other day, but there's been a first tier tribunal case where the substance of a partnership was brought into question, and that partnership held a property, I think for development purposes, that was transferred into a company. Anyway, the long and short of it was the taxpayer lost. There wasn't sufficient commercial substance or even evidence of the existence of a partnership. So care does need to be taken. It's not enough to create a partnership and just submit partnership tax returns and do partnership accounts if the underlying sort of operation of the partnership doesn't kind of stack up. That is where an LLP can be useful, because an LLP, as a matter of fact, is a partnership. Hopefully that answers the question.
It does, James. Thanks. Raises all sorts of complexities, devil in the detail, and staying within the spirit of the legislation all in one, I think. So I am very sorry to say that we've now run out of time. So as I say, James is very kindly going to be able to pick up with you afterwards. You will get a copy of the slides, which are also going to be held on the Personal Financial Planning Community's site, which, if you're not a member, then do please join. I believe there might be a slide popping up in a second that will just flag that up. but there's no charge to join that. There we are. So just clicking to follow the link, and that will enable you to join. You will be getting a survey as well, actually, afterwards. So it's all really helpful to give us your feedback as to other areas that we think you'll be useful to cover. So my thanks to James, to MHA, and indeed for everybody that's joined today's session. It's been hugely informative. And again, thank you, James, for your encyclopedic knowledge and ability to convey that in such clear terms. So thank you, everybody, and I hope you enjoy the rest of the day.